All right, Ken Range Theory Trader back with you with another video on talking about the intraday price action elements when it comes to the candle range theory. So let's not waste time and get right into it. So the elements I'm going to show you, they're all on the 5-minute chart, and this is just on any given trading day. All right, you already have your bias, you know what you're looking for. This is really just to show you that you have the direction right for the day. This is more so for day traders than swing traders. And do you really need all these things? No, you don't, because if you just want to take one entry and be done, you really don't have to worry about this. But this is more so for people who may want to scale in, just need an extra confirmation to make sure they're in the right segment of the market. So you can use one of these, use two of these, use all three of them. Either way, it doesn't matter. All right, so they are the elements. The fair value, they are fair value gaps, swing highs and swing lows, and the daily open price. Now, what is a fair value gap? There are tons of videos on YouTube about fair value gaps. You can look at those for like if you need an in-depth study on it. That's not the point of this video. It's in essence a price imbalance where the candle's high and low is not fully overlapped, so it just leaves a gap in price. All right, and the main point of using a fair value gap, I like it for the fact that it can show strong momentum. Now, keep in mind, they're not set in stone and they can fail, but if you do see one in the direction of your bias, it can be a good sign. So this is how they look using an indicator. If you just go to TradingView and type in fair value gap, there's tons of indicators to choose from. This is the one from Nephew Sam. So if you see here, it's a 3 candle pattern. 1, 2, 3. On the close of this candle right here, this red candle, this gap appears whereby price just goes straight down. It does not trade back up into it. So it moves so fast that it creates like a quote unquote gap in price. Okay, I hope that makes sense. So some people they'll take this as an entry signal as well. Sometimes you won't see fair value gaps and still have a valid entry, but some people, if they want to wait for this confirmation, they will do that. And as well, you have here another fair value gap where you have 1, 2, 3 red candles. Some people like to see fair value gaps with all of them, all the candles being the same color. It just depends. There's no one set way to trade them. But once they see that and then price trades back into the gap, they take an entry on that, tight stop loss, and see what happens as a result. So that's the fair value gap. The daily open price. The daily open price can be a point of support or resistance. Ideally, you want to buy or go long below the daily open, and you want to go short above the daily open in line with your bias for the day. So this is how something like that would look. This is actually the same chart I just showed you. This is a pound New Zealand, where you see price did rocket up by the daily open, and it acted as its point of resistance and bounced right back off of it. Will it happen all of the time? No, but at the end of the day, typically you don't want to go short below the daily open. Now, that's not 100%. There will still be trades where you can take a short below the daily open and get paid. I'm going to show you one in a few slides. But ultimately, when price approaches the daily open, you have to realize that on the daily chart, it's like a doji. So price could go either way, up or down, but so it has to be in line with your bias for the day, in line with the candle range theory. Now, swing highs and swing lows are easy enough. It's a 3 candlestick pattern as well, whereby the middle candle has 2 candles on either side of it that are showing a potential reversal point. So you have a high, higher high, lower high. Swing low, you have a low, lower low, higher low, and it just creates like a U or a V on the upside, or an upside down U or a V. And however you want to see that is going to be in line with your bias, and that also gives you a signal that it could be time to possibly take a trade. So there's tons of videos about swing highs and lows. That isn't the point of this video. There's an indicator as well you can use to identify swing highs and lows. But remember, you only looking at them in relation to your bias of the day. So let's say if you have a short bias, when you see a swing high, you take that as okay, this could be a good resistance point, and price should continue away from that zone. Here again is another swing high where you have a high, higher high, lower high. So it creates this swing high and it goes down. Another one here, high, higher high, lower high, price continues down. So that's it. So that's really like, you have a swing low here, but we're not worried about that one because we're not long for the day. We're short. So we're only looking for swing highs. So if we put all of that together, okay, this is how something like that would look. Now, do you need to do all of this and have all of them all together? No, you don't. Excuse me, I have to take a quick drink of water. Now, so say for instance, we had a long bias for the day. Okay, so here's our low of the day right here. Price goes up. It has 1, 2, 3 green candles. It creates a fair value gap. Price retraces back into that fair value gap, and that fair value gap needs to hold for it to be valid. So one way you have 2 ways to enter. you can either enter when this third green candle closes. That can be your first option. Or if you're patient, you can wait and possibly get a tighter stop loss and wait for price to retrace into the gap and take an entry anywhere inside the gap with a stop loss being outside the gap, or in this case, below the prior day low. As well, keep in mind price is below the daily open, so we like to buy below the daily open if we have a long bias. And then as we see, price just rockets up. It does retrace a little more and then goes up again. We also have swing lows here and here created at the low of the day, and another smaller fair value gap here with three candles, 1, 2, 3, and it goes up again. So, and then a very large one here, but we're not trading up here because this is above the daily open. All right, so that's a long example. Okay, so that's putting them all together. Now, here's a short example. But remember, this price action is below the daily open, okay, or in the weekly open as well. But I'm not talking about that. This is just for the day. But this is a case where swing highs would have came into play if you were bullish or short. I'm sorry, bearish or short for the day. We have these multiple swing highs here, 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 and here. So these two entries could have been, you had an opportunity here off of this swing high. Price went down, came back up, and then just tanked for the rest of the day. But no fair value gaps here came into play. This, if you just like the option of a swing high, just use those. You don't need to have fair value gaps. Okay, if you just want to say, hey, I got my bias, I just need to see some swing highs, and I'll take trades as I see them. Do that. That's more than fine. This is a short example with fair value gaps. So you have your high of the day here. You have 1, 2, 3 red candles. It creates two back-to-back fair value gaps. So you could have entered right here off of the close of that third candle. Or as well, you have another fair value gap here that was created, and then price went down. We're not trading here because it's below the daily open. Price goes up, trades back into the fair value gap, and then goes down. So hopefully you see the power of that. But it's just as easily possible for price to keep going up. That can and will happen. So again, fair value gaps, sometimes they hold, sometimes they don't. So just be sure to use a stop loss if you want to take that approach. All right. So, and then this is using both swing highs and fair value gaps on a bearish example. So obviously we trade away from the high of the day. So here's our high of the day right here. Fair value gap create with 3 red candles, 1, 2, 3. So we like that. So see these little tiny retraces, you could have got in there or there. There's plenty of opportunity. Price tanks, spikes this fair value gap. A lot of consolidation around the fair value gap as well. This one here, and it pins this one up here, but notice they still hold, and then price continues to drop the rest of the day. Once price goes below the daily open, okay, we're not interested in that. Okay, we're not trying to go short below the daily open. That just doesn't interest us, all right? So it's very important to know when to get in the market and when to get out, stay out of the market, depending on your bias for the day. So in conclusion, the main benefit of using these elements, either one of them or a combination of them, is that it tells you when to get into and stay out of the market. For instance, if there's no fair value gaps, you're not trading. Okay, there's only a few zones that you can trade here, either on the close or when price retraces into it. You're not trading down here, you're not trading down here, and you're definitely not trading down here. You stay out. You only get in narrow segments of the market so you can have those tight stop losses. All right, that's how that's supposed to benefit you. Okay, if there's no swing high or low, you're not trading. So for this other example here, if you're just using swing highs and lows, what I like to do is for swing highs or lows, either way, they create to me like a zone. So what I like to do, sometimes I'll draw a box around the 3 candles that create the swing high, and I say, okay, that's my trading zone. So you could have did that just as easily on this swing high zone right here. We have the high, higher high, lower high. You just draw a box around those 3, the high and low of those candles, and that's your zone. And that zone held up right there, okay, as long as it's in line with your bias. So that's how you could use a swing high or low. It's really just support and resistance at the end of the day. But again, this is in line with a candle range theory bias. All right. So typically this is during the time of the third candle. All right. If you remember the 3 candle pattern, this is in line with the direction already being underway. Okay. So that's that. So as well, tight stop losses. So the swing highs should always hold and fair value gaps should always hold. Okay. Your stop loss should go slightly outside of either one of those. Okay. If it breaks, then the trade's invalid and you need to get out. And if you nail the direction of the day, you should see swing highs or swing lows develop as momentum picks up. All right, so that's the main thing. So we'll take a look at one live example real quick, and then I'll let you guys go for the day. But that was pretty much that's the bulk of it. But let's take a look at let's just say Aussie CAD for instance. If you just wanted to use and I don't have a bias on this. This is not a full candle range theory study or anything like that. But let's just say if you just wanted to have, mm, we'll do the swing lows. So we'll get rid of the fair value gaps. And let's say I had a long bias on this day. All right. Again, just spitballing here, just making this up. But just so you can see, it plays out in real time. All right. So do I even see any swing lows below the daily open? I do right here. So when I talked about drawing the zone, this is how I would do that. If I had a long bias on this day, you just take a little rectangle tool there. This is the low, lower low, higher low. So that's the low of the candle to the high of the third candle. And you can say something like that. Okay, and then I just wait. So I say, okay, as long as the low of these candles doesn't get closed below, that could be my golden zone. I'm not trading up here. Okay, now I know this is where I get into the market. If price is outside of this rectangle, I'm not trading. All right. So that's the swing low aspect of it. All right. And again, daily open comes into play because daily open is right here. This is the mark levels indicator. That will show you that. And then let's try a fair value gap one. I'll just pick one at random. So I'm going to get rid of the swing lows and highs. Let's see if there was any opportunity here. Yeah, there was one, but I think we could do better. Let me see one that's trended a little cleaner. Yeah, okay, this one will work. All right, so this one right here. So obviously has strong momentum up here, and then price just retraced down into this gap. Make this a little bigger. All right, so you could have entered, anywhere in there. The size of the gaps don't matter. I know people ask that. Do it have to be big gaps, small gaps, tiny gaps? It don't get caught up in that, okay? Sometimes they hold up, sometimes they won't. This is two back-to-back gaps, but I would just put my stop loss below the gaps low, or if you want to set a price alert, that either way is fine, like that. Okay, so either one of those, and again, it's just about zones. Now, notice as well, though, this gap is above the daily open, so sometimes you have to play it by ear, for lack of a better term. Okay, be loose. The daily open is the most flexible one, but what's not flexible is fair value gaps and swing highs and lows. Okay, once if those get compromised, get out of the trade. All right. Okay. So, but again, that's just a way for you to know you got the direction right. You're looking for that confirmation. Look for gaps to the upside or swing highs and lows. I'll throw that back on this chart here real quick. Right there. And you see the swing lows, swing low right there, swing low right there, and they hold. So, that's it. So I appreciate your time and attention. Hope you have a great rest of your day. Appreciate you watching and take care.